Hi, I'm Dan Dickinson, a tax partner in GT UK and also the firm's lead for ESG and tax services. Thank you for taking the time to watch this introductory video today. This video is the first in a series designed to help you understand the value that tax can add to your organisation's ESG agenda. Um, the future videos will be a bit more international in nature, featuring some of our Grant Thornton international member firms, but for today, I'm afraid you're stuck with me. So where does tax fit into an organisation's ESG agenda? I might be biased, having worked in tax for 20 years, but I firmly believe that tax cuts right across the whole of an ESG agenda and therefore can add significant value to that agenda. Today, I'll give you a little flavour of how tax fits into some of the environmental and governance issues as part of an ESG agenda, but those will be covered in more detail in further videos. Before today, I'll also spend a little bit more time on how I see tax fitting into the social elements of your ESG journey. So starting with environmental issues, all of your organisations will have targets to reduce perceived damage to the environment. Whether you're a heavily polluting entity or even someone who makes investments into those types of entities, you'll all have these targets. Similarly, governments around the world, they're seeking to show progress against their economy-wide targets and their legally binding commitments. Carbon emissions reductions always get the most attention. However, we shouldn't forget other externality causing products such as non-recyclable plastics, landfill, and other things. Change programs have complex cost-benefit analyses, and tax can really add value to those through horizon scanning, through spotting where additional environmental taxes will add costs into your supply chains in the future, as well as incentives that can be accessed to help fund expensive change programs. This stick and carrot approach will be covered in separate videos coming up in this series. So moving on to governance briefly, the tax government requirements you all face have mushroomed significantly over the last few years. Where I come from in the UK, we have a raft of legislation that must be followed, things such as the Senior Accounting Officer regime and the Criminal Finance Act. Other regimes around the world are also increasing legislation in these areas, and some of these examples will also be covered on an upcoming separate video. Now, I even view the OECD's Pillar 2 minimum tax revisions as a governance requirement born out of a focus on multinationals' contributions to society. It's critical that your internal stakeholders understand the importance of the tax function meeting these governance requirements from an ESG perspective, because one slip in meeting one of these can really undermine your organization's overall ESG strategy and sustainability messages. And of course, if you're already on top of these, that's brilliant, but you should be shouting about that internally as your contribution to a positive stakeholder perception of your organization. Now, I said I would spend a little bit more time in this video on how I see tax fitting into the social elements of an ESG agenda, and I've already touched on this when mentioning Pillar 2. The public's interest in corporate and multinationals tax affairs has never been higher. In the UK, the most recent manifestation of this has been the public and governmental focus on so-called windfall profits of energy companies, but really a critical analysis of companies' tax affairs and their contribution to society through tax has really been in the public domain since the global financial crisis. As part of this, a desire for increased transparency has led to a number of consequences. The larger businesses amongst you will be very familiar with the country-by-country reporting rules, and those of you with European businesses will be aware of the upcoming public version of these rules, which will put a huge amount of extra tax data into the public domain. Now, these provisions are compulsory if you meet the size thresholds, but we also see a number of voluntary transparency initiatives that organisations are increasingly taking up and including tax as part of that. At the last count, approximately half of the FTSE 100 listed businesses in the UK voluntarily publish a so-called total tax contribution document with their financial statements. Outside of the UK, we see standards such as the Global Reporting Initiative and the Dow Jones Sustainability Indices being increasingly considered as an extra tool to provide more transparency around organisations' tax affairs to various stakeholders. Now, these stakeholders can include your customers, your employees, your investors, your lenders, and this wide net of stakeholders may well mean that particular rules are pushed down to you, even where you don't meet the specific size thresholds on a standalone basis. Now, whether or not you choose to undertake a voluntary initiative is a complex question, but I think it's one that you'll be increasingly asked going forward as a tax and finance function. Now, just to finish this section, I mentioned employees briefly, and their perception of you as an organisation is critical, and your tax affairs as an organisation is a key part of that. But tax can also play a real part in shaping overall employment packages in line with an ESG agenda, whether that's through pension fund choices, mobility packages and policies, overseas employees, and benefits such as electric cars and helping with home insulation. As a tax function, you should be at the table in all these policy discussions, as you will add significant value to that. Now, to wrap up, I appreciate this being a very quick run through of what is a complex and evolving area, but I hope you've taken something from it as to where you may be able to add more value from a tax perspective. As a key takeaway, I would recommend that you seek to fully understand where your organisation is investing the most across E, S, and G, where their focus is. The larger organisations amongst you will have a sustainability lead and a team that can give you that insight. For the smaller organisations amongst you, it's about a conversation with the board and the owners potentially. And once you understand these areas of focus, you can then begin to fit your tax effort to that and where tax can add the most value and help your organisation achieve its objectives. Now, I said we'll publish 3 additional short videos soon. These will be international in flavour, with one focused on environmental taxes, one focused on environmental incentives, and one being a deeper dive into tax governance globally. I hope you'll be able to watch these videos, and thank you again for taking the time to watch this introductory video today.